None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. Here we are Monday morning again, having fun as usual. Market's opening higher and trading off right now, and there's nothing to talk about as far as news goes, and that's going to be it for the whole week. Like I talked about in commentary, is that we have maybe the biggest report is jobless claims, or maybe FOMC meeting minutes on Wednesday, but I don't think it's going to mean much. Any of these things aren't going to be material. We kind of kick off earnings season on Wednesday with Alcoa and start to get some things going there, but that's what it's going to be about. So for the moment, we have already had a climactic event for the month, and as I said in commentary, what now? What's next after the unemployment numbers? So we're really not, there's really nothing out there, and this goes to the whole theme that I've been talking about the last couple of weeks, is there's very tough reason to find a way to own stocks, and we'll be going through this shortly. But VPM once again saw another big tranche of orders. Most of the stuff, and we'll go through this shortly, is things that nobody owns, allocation funds and the like, right, Mitch? That's
right.
Much, yeah. So for the most part, there's not a lot of effects. There were a minimal number of stocks being sold, so probably most of you aren't seeing a lot of changes in your portfolio, even though the database continues to change. And I've been talking about it getting to this 29 to 22%. Well, we're 29 all of a sudden, and
right.
maybe we're getting close to the bottom. We'll go through some of the details here shortly. But as far as news going on overnight, Europe, pretty boring actually. There was nothing going on even in Europe, other than Europe seemed to be in a rebound mode, and that was affecting our futures last night when I was doing the commentary. I usually stay up and watch the open on Europe so I can get a feel for how things are going to trade, and it was pretty obvious that we probably weren't going to open with the futures up 900. From where we were last night, we're down 400. We're 14 handles different than we were at midnight Pacific time last night. So it's not a lot going on other than some reality coming into some of these numbers. And I did think it was interesting that all of a sudden, right before a big election again, the Commerce Department comes up with all these revisions and a 5.9 unemployment. And Obama was on the other day talking about what a great job they're doing, even though our participation rate's same as 1976 or something, 36 years ago.
Yeah.
So nobody's really working, but we're doing a good job. And but the bottom line is it's interesting because we saw the same cooking of the books, and that back in 2012, and now we're seeing it again. And it's interesting what happened after that, because we did see some downward revisions. So all of the hoopla, I think everybody's coming in and realizing that these numbers are all probably going to get revised down now that they get revised up, and in the end they don't really matter, because that's not what the market, what's going to drive the market higher from here. And I've talked about this several times, is that the markets tend to think ahead of the market, of the economy. So, well, if the jobs are going to continue to improve, the market's unimpressed at this point because we're going, yeah, we already know that. Tell us something we don't know, and there's nothing to tell us that we don't know right now. The Fed has no bullets. Mario Draghi and ECB, there's some comments coming out. Mario's talking later this week. There's not much there. He's already said what he needed to say last week, which was the same thing he said last month and the last month before. And they have no way of executing the ABS program, which is the asset purchase program that's in Europe that's supposed to add liquidity, and liquidity isn't the issue. They're trying to force banks to lend. They already have a zero interest rate. That's not working. Nothing's working. So, yeah, it's just going to get more interesting from here, folks. So as we go through the technicals and what continues to unfold there, I think you'll see more about what's going on, and just the activity. When I go over to the charts, I'm going to bring us into the futures arena when we start today, just so you can get a feel for the 24-hour charts and what's going on, and how there was a fair amount of enthusiasm. And of course, in the backdrop now, Ukraine, what's that? No one remembers, right? It's actually not even in the paper right now, even though it's pretty much the same as it has been. But now we have Hong Kong, and already the Ebola thing is gone. I mean, try to find it anywhere on a headline. You can't find it. It's gone. So until there's more events there, all of that, nothing's going to be. There's just nothing out there. The markets are grabbing onto straws to find something to base market sentiment on, and it's going to be, I think, ultimately back to basics, which will be about earnings and about those things, and it's really going to be about forward guidance going from there. Did you say anything out there, Mitch, that we can talk about?
The only economic report that came out today was the consumer spending measure, which dropped from 94 to 87. So that's, as the talking heads pointed out, that's still a year.
I never heard of that one. I guess I've been doing this for 35 years. That's a new one. The consumer spending measure?
Yeah.
Oh.
So that one, that was the only anything close to economic report related.
Was that an academia from the University of I don't know.
It's a Gallup measure, so.
It's a survey. So it's a survey.
It's a survey, yep. Yeah.
Okay.
Aside from that, we talked about it on Friday as far as the employment situation coming in, and they revised the last 2 months. They talked about how August was such a nice revision from 142 to 180. However, that's still 50,000 less than what they were originally expecting. So.
Right, but you did get 60,000 in July or something. There was another bump in July. So
yeah.
It kind of made it
from 209 to 212 in September, and then it went to 243. So
if you do all the numbers, you got right at 200 again.
Yeah.
For the 142. So it's just all of that, and of course the participation rate is what got the number down under 6% to 5.9, and certainly helped, even though there's a little bump in employment. But yeah.
Yeah, but the quality of the jobs still aren't there. That's not the right people getting the jobs.
And were you saying you had to be 12 years 50, old or 100?
That's right. You had to either be a teenager or
above 55.
Above 55, and
which
those are the only places that saw an increase last month.
Yeah,
so.
Which means you're probably a greeter at Walmart. Sorry, I'm above 55, so I guess I control that group. I guess I'm part of that group. I think the boomers are doing 1 and 2 jobs that maybe that didn't do some of the things right earlier in life. So anyway, let's go ahead and get on to the technicals and start digging into things. As I said, I'm going to come into the futures here, and they are negative on the session now. We've bounced a little bit off the lows, but we're not really seeing any enthusiasm or follow through from the big rally on Friday, which was pretty much the expectation. About a 60% probability for a lower close today, and as long as we stay under, really 74.15 is going to be the magic number, which I think today we'll take a look at where the ranges were. We may have come in just below that level, as it turns out. As I look at the futures, and you're looking at, these are 24-hour charts, you see that everything's rolling over. I don't expect any drastic moves here, a giant decline, although if some of the elements that start to come into the marketplace, and we start to see more selling and disbelief about these numbers, and maybe what we were just discussing about the market sentiment and maybe some cooking of the books, if you will, that might be enough to keep it under pressure for the balance of the session. But I don't see any big down day today. The pattern suggests that we're probably going to run back toward the 1950 to the 1941 level. The weekly ranges that are on the reports that we put out on Monday, the S1 number, otherwise support 1, is 1956. 1944 is the S2, support 2, 1944.05, and then below that's 31 and then 20, which would be a retest of last week's low. I suspect we're going to do probably an R1, S1 maybe, as we could get as far as S2 this week if we see a lack of follow through. And like I said, there's not a lot to drive the market. So if you're looking for enthusiasm if you were a bull, which I can imagine you would be hanging around us right now, you're much better off as we go through what we sold this week, and you're much better off having a much more neutral, heavier cash position right now than trying to own this thing on these little bounces that we saw from. And in the reality is the 1926 low that was printed the other day on Thursday was kind of an aberration. It wasn't real to start with. It was mostly in response to extreme weakness. I think Italy was down 3.3%. Germany was down 2 and change. There was a lot of selling going on in Europe after the ECB and Mario Draghi's conference showed nothing. Gave Europe no hope. And the problem is they are in the no hope mode, and there's nowhere to go. And there are hot spots, and actually the UK is doing better than Europe as a whole, but there are a couple other spots, but they're small little ponds and they're not affecting anything. When you get into France and Germany, there's lots and lots of issues. And the Ukraine story that's no longer in the paper is still existing, very much so in Europe because of the sanctions that are going on. So there's ongoing situation there. Hasn't been any real escalation of those things, but that's pretty much what's going on there. So as we go through a continuation of what's going on, let's go over and take a look at the cash real quick. And I need to do one thing here real quick, folks. Excuse me, I've got a little glitch going on for 1 second. I've got to go off screen just for a sec. Okay, so as we look at look at the cash markets here now, we'll look at the cash. Here's a daily cash. We're now down 386 in a day. We were higher off the opening. Momentum, as we look at the PPM 1, 2, and 3 here in a daily, minus 0.15. That actually got to 0.32. This little spike down. I'm got my cursor on over on the right hand side. So we got to trend mode for a minute, and now we've rebounded back, and you've got all the indexes basically flat, which what I discussed in the commentary is that I thought we would have a sideways pattern to develop, and I suspect what I just talked about on the weekly ranges is exactly what's going to happen. So this S1 R1 range, which is 1956 to 1979, is probably going to be the higher end of the range. You can see today we got a 77.84 high, and that's probably going to be it. There is some possibilities for the market to get up to about, we can probably get up to maybe 80, 81, as high as 88, but that's will become less and less probable depending if we close lower today. Chances are we're going to see at least two days lower as we go through midweek. So this pattern is setting up. You can see that from a PPM standpoint, we've upticked here on PPM 1. we're still in a major decline, and ppm 3 is starting to turn south, and ppm 2 is in a declining mode, seeing momentum dissipate fairly quickly. And this is a very short-term viewpoint right now, but this is exactly where this market's going to make and generate any kind of turn. And right now there's just nothing there, and there shouldn't be. That's exactly what's going on from a fundamental standpoint, and any of the news that's going to affect this. There's not much there. Looking at the weekly graph, we have the same story pretty much unfolding. This thing is not moving a lot. We have ppm 1. Let me bring that on screen so you can see this. ppm 1 is, get to the right place here. ppm 1 is 0.20. ppm 2 is 0.21. And ppm 3 is 0.07. And all of these are below the trend level, but there is a slight bias to the upside yet. And this is keeping the relative bid in the market from the viewpoint, from a technical viewpoint. There's still an underlying bias slightly to the upside, but it's not in a trend mode, which is suggesting that the probabilities of the markets going to a new high are fairly low. They're less than 40%, probably closer to 30% right now, from the standpoint of what's likely to emerge out of a pattern like this. There's still a lot more risk on the downside than there is on the upside on this particular pattern. And you can see there are still valid targets here. Over on the right hand side, you can see the high targets being generated here in this drop down menu that I have right now. The high target of 1973.72, so we're above that a little bit. That's going to be a resistance. But these two higher targets of 2034 and 2072, I did not mention those in commentary, but they are still valid upward objectives, but the probabilities are very low for us to get there now because of the configuration of how everything has started to move south, and we saw a lot of dissipation of the ppms as far as the momentum is starting to dissipate. So those probabilities of getting to those higher levels are pretty low. What will negate these numbers is a move below that 1905 number that I've been harping about for multiple weeks now. That is the key number, which is I believe the July or August low. Let me just look at here. That's way back when. We'll look at that when we get to the monthly graphs here in a minute. But you can see overall, ppms are just flat, and this is typically what they'll do during these expanded uptrends. And as we start to see markets roll over, we're pretty much running at the same pace right now, where, like I said, ppm 1 is 0.20, ppm 2 is 0.21 and 0.17. So all three of these moving averages are rising at a very similar pace right now. And there's just not a lot there, which typically you're going to get is a kind of a, I guess, sideways pattern indicated, like I said, from there. Let's take a look at the monthly graph and take a look what that's at. This is the number that I keep talking about, that is really important, at least very important to me. Let me bring this drop down in so you can see these numbers here. But the ppm 1 is 0.61, under 1%. ppm 2 is 1.26. That was 140 not that long ago. So it's starting to decline. It's very close to breaking through its second derivative, which is, you'll see here on ppm 2 is 1.16. So we're a little bit above that. When that breaks down, then that's going to tell us that the 21-month moving average is also going to start to slow. We're already below 0.1 on the ppm 1, which there is a collision course happening on these two moving averages. So I'm sure those of you who've been watching this is the same scenario I keep talking about, but what we're looking for is the next crossover of these averages, and that will tell us when we'll get more of a sustained trend, when there's going to be much more pressure on the markets from that standpoint. Right now we're still in the trend mode. We're still above that 10 period moving average, which is, even though it's up 0.6, that is strong enough to keep the markets above there. You can see that average right now is 1915.32. And this is a monthly average, so it's not going to change much from that number. And it was at the worst case last week. I remember seeing it around 1911 as far as that value of that average. And this is, like I said, pretty typical. We're going to have to get below this average, but most important, we're going to have to get underneath that low that was, I think it was the July low here. I'm just going to bring it up real quick so I can get to that. This is going to be your key point here. Get up to the top. 1904.78 is the low of July, I believe it was. And that's going to be the key pivot number in the pattern. Is going to be the key low to watch. And the fact is that we may just dip below that. We may get another rally back after hitting that. A lot of times you'll see these numbers penetrate and you bounce, and you wonder, was that a valid trigger? And it is, but a lot of times by the time you get to those numbers, depending on how they get there and when they get there, is that the market gets fairly stretched. You'll get a relief rally, and then the next sell-off is the one that takes us down. And as I've talked about this before, the probabilities are that we're going toward the 21 period moving average, which is rising at 1.26% per month, but is currently at 1784.88. And that number will be slightly higher, so we're going to be, there's a range from a Fibonacci standpoint that tells us around 1818 to this moving average range, 1785 is the target range. I think did we figure out what the decline was on that, Mitch? It took 1784 off current value, what that percentage decline was. Can you
well, right now it's 9%.
Okay.
I think when all is said and done, it'll be about 12 or 13% from the highs.
Yeah, so what should happen, I keep talking about this because this is the super slow-mo. What's nice about looking at this monthly graph is you have time to think, and that's one of the reasons. If we brought up a 1 minute graph, you have minutes to make decisions, and there's a lot of noise in those graphs. As we get into this monthly graph, the noise is minimal from the standpoint you're going to have the bars all fit together. If you had a gap on a chart on a monthly graph, up or down would be so unusual. You can see this chart here. This is cash S&P, so it's not a futures or any kind of adjusted price where prices can jump. It's nearly impossible to get a gap on these charts. So those of you that are technicians understand that those gaps are usually significant. You're never going to see one on this chart. If you did, it would probably have been a disaster where the markets just completely declined. You can even go back to 2001 and go to 9/11, and it didn't gap in that period of time. In fact, if you recall, in 2001, the markets were already down pretty. It was not a good year. By the time we got to September, matter of fact, I remember we were over, I think, 60% in cash. It's similar to what we are right now. When 9/11 happened, the market was down, and we were already protecting the assets, so there was minimal effects when that happened. So from a monthly standpoint, this chart is actually starting the beginning phases. I've said this before, but somewhere between right now and the next 4 months, it's going to take to formulate this top, and then after that top, we should start to see these declines to 1700, and ultimately we should see a test of the 40 period moving average. And at that point in time, that's going to be, right now, that number is 1575. So that's quite a bit. It is rising about 1% a month, but that's not a lot. That's like, what, 15 points or something a month. So it's not a lot. So you can go multiple months, and maybe it gets a little bit over 1600. So there is ultimately a decline, probably 14-15% to get there. And in the past two situations that we've been in, let me bring up the whiteboard. And if just looking at this graphic here, and we can go further back, but I'm drawing a mark where these events I'm talking about are going to happen, is every time this 10 period moving average starts down in these patterns, once it starts down and it crosses through all three averages, is when you get the acceleration of prices on the downside. And 2008 was a sharper decline than it was in 2001, we call it 2000 to the '03 lows. Think about going back, okay, there was a dot-com burst. Other than if you take out the 9/11, there just was a bad economy. There was a lot of shifts going on at that time. It was not a banking crisis. It was not, there weren't TARP programs and the Fed bailing everything out. None of that stuff was happening then, but yet we still were able to decline around 40%. And this was pretty normal markets. The only thing that happened in 2008, of course, right about here where you see this steep drop, is where Lehman happened and the banking system became under even more stress to the low. And then all the stimulus came in at these lows as the government was panicking, trying to bail everything out they could, putting a massive amount of liquidity in to save the market. And of course, they did a pretty good job, because look at where we are today. As far as in assets go, they were able to inflate the stock market. They've been unable to inflate the housing market at all. While prices are up, we're a long, long ways from 2005 and 6. So far that it's not even worth talking about. I mean, we talked about the other day is that all of a sudden we've gotten all the way back to 2008 numbers, and I don't remember July of 2008 being all that much fun. That was right smack in the middle of the mortgage crisis. Nobody could refi or buy or do anything at that time. So you start looking at the stats that are out there, it's somewhat, I guess we'll call it somewhat depressing here from that standpoint. So let's take a look at a couple other things here before we move on. One of the things I didn't look at here, we're trying to make some sort of rally back here. I'm going to pop over to the chart here. We just are about to have a low cycle come in on the 5-minute futures. So expect to see some rebound. I would expect that we go back positive on the session a little ways, or at least try to. If it fails there, then the next low cycle will be closer to the close, or maybe shortly afterwards, remembering that these are 24-hour futures charts, so they never stop trading. There's 15 minutes every day that they're not trading. So this cycle will continue through the night and roll over, and this is likely to be a low where we're coming in right now. We should see a rebound in the market, start to rally back up, and we'll see what kind of enthusiasm can be generated, especially with the news already being out and not a lot to focus on. Let's go over and take a look at a couple things here that we haven't talked about for a little bit, but let's look at treasuries, and we're going to look at the dollar real quick here in a minute. The treasury market, this is the weekly graph. They are very flat. We have remained in this range. 262, 263 has been the top end, 240 on the bottom side. So we got 20 bips on the downside. We have $61 billion of 310s and 30s being offered this week. And that's pretty much every week anymore with the deficits like they are. We are really pushing the envelope on demand for treasuries. And as I've said before, the phenomenon that's going on is that as long as the dollar is strong, which it rallied again, we're going to go through that in a minute, we're going to continue to see a bid in the treasuries, because if you're in Frankfurt and the dollar's going up and you can buy a 240 yield, you're all over this thing. And folks in Europe are going, if you bought some treasuries then and you can't figure out what else to do, is buy some more. And this is like the most bullish trade that everybody that's not in the U.S. is playing. And you can play, we can't play it the same way they can unless you do some spreads and you're smart enough to do some currency swaps on this thing to make it happen. And that's the only way to play it. So you'd have to go, the way you do that is go long the dollar index and buy the bonds. So you're just doubling down on this market. That's the only way you can participate in that trade, which is not a bad trade to do if you're sophisticated enough to do that. But the bottom line is that's the only way you can enhance treasury yields. Actually, maybe I just stumbled onto something, because but it's a speculative way to enhance treasury yields by using the Dow. And the Dow, as we go through it, the Dow's not completely played out. There's still some on the upside, but that's the way hindsight tells you could have played this. And the Dow index, if you brought it into BPM, we've been long that index, especially if you're doing the daily graphs or even the weekly. We'll bring that up. But so the treasuries probably are pretty much at their low. They could dip a little lower. I guess if Europe gets a little crazier, negative yields go even worse, and the Bund goes even further under 1%, then that's a possibility that this bid is going to change. And until there is some kind of traction, something that goes on in Europe, this is the way this trade's going to work. So I get what the folks in Europe are saying from the standpoint of about this trade, and it does work. It's one of those crowded trades, but it's one of those trades that you can read in the Wall Street Journal, and it works for a while. How long it will work, it's actually been working really, really well for the past 3 to 4 months. So this has been a really big trade for a lot of people, because there's not a lot when you look at the indices in Europe and stocks. You've got to talk about being a good stock picker. You've got to be really good to make any money on this stuff. So let's take a look at the Dow. So Dow is off a bit. We're off 0.75% because it was up 1.12 on Friday. So we're giving back some of this Dow strength as well. Going back to the trade I was talking about earlier, as a standpoint from how everything's configured on the stock market, and everybody realizing that the numbers that they put out on Friday weren't real either. They weren't any better than the August numbers in hindsight, because they're going to adjust everything back. The 240 is not going to be, or 248 is not going to be 248 next month. So the bottom line, what's going to happen here is that's what everybody's responding to. But like I said, this trade, I see this Dow getting pretty much done. I'm going to go, this is the Dow weekly chart. I'm going to go to the shorter term graph real quick here, and I want to bring up, yeah, there we go. Probably not the 15-second chart. That's not the one we're going to want.
Very short-term chart.
Yeah. We want to go to the daily graph. So now you can see there's some Fibonacci objectives, and we actually hit one of them. Let me bring this up on screen so you can see this. The targets on the upside are 87.12, 88.37, and 89.13. This is the VPM Fibonacci target range. And so we're looking at the high today was 86.68, got pretty close to 87.12. As a buddy might say, that's pretty close for government work. You're close enough to call it a hit. And when the market reverses off of a price like that, so we saw some strength earlier today, and then you see the reversal happening. But this is pretty much coming into the range, the cyan line and the green line, which is the 87 to 88.37. That's going to be a resistance point on this chart. Two things are going to happen. We've got pretty reasonably robust numbers. We got 0.22, 0.16, and 0.15 on ppm 1, 2, and 3. So moderate trend range. There's a slight bid underlying this thing, but that's where we are on this chart. So we've pretty much played out most of this Dow move. So don't go and go long to Dow and buy treasuries and go buy the treasury futures. Don't do that trade at the moment. You'd want to find a better point. That's been the trade. It's sort of like when they announced that the Russell was in correction mode. If you notice, the Russell rallied the day they announced it was in correction mode. What they meant, it has corrected, not it's in correction. So it's one of those things. I don't know who came up with these silly 10%, 20% numbers, and it gives the talking heads something to talk about. Normally when you get to those numbers, Mitch and I talked a little bit about it on Friday, I think, where we did a study of all the declines, and about 22, 25% was about it. Wasn't that, Mitch? Something like that?
I can pull up the report right now if you give me a few minutes. Yeah,
so we'll talk about that in a minute, but that's exactly, when you get there, it's pretty much it's done. But what happens, those are from an index standpoint, and when you start looking at individual stocks and the rotation is happening, and that's what we saw when we go through in a minute. Mitch, I'm going to bring Mitch up after I get through this Dower, and we're going to go through all of the stats on the database. Well, that's what you're seeing on the database is more and more things just being scaled back because nothing is trending. And you have to understand something about a mutual fund, by the way. It is actually a managed asset. Mutual fund managers are making decisions how to overweight, underweight, all those things. And chances are when they get a little scared, they're underweighting these mutual funds. When the market rallies back, guess what? The fund NAV doesn't rally back the same because there's been changes made. If you were to go spend a day on a trading floor at your favorite mutual fund, your mouth wouldn't close after you saw all the trading that was being done on every fund that you own. There's constant turnover and adjustments and things going on. The same guys that told you can't time the market spend all day figuring out how to time the market. It's kind of ironic, isn't it? All they want is your fees. And the bottom line is everybody's trading. That's why billions of shares change hands every day. There is no such thing as buy and hold. Please understand. Nobody actually buys and holds. Some guy at some university, some academician came up with that idea. So anyway, let's go in and I'll bring Mitch up here and we'll go through real quick. I'll bring him on screen here. There's Mitch. And we'll go through the numbers here as far as I'll let him go ahead and do the numbers on in this chart. 1 second, Mitch. I need to control for 1 second.
All right.
So you're on. It's all yours.
All right. So just to get things going, this week we saw 2,282 sells across the database. We had 229 buys, giving us a net change of 2,053 sells across the database. So we saw quite a bit more selling again this week. On the stock side, we sold 150 net on the stocks. On the mutual funds, we sold a net of 625. So again, just like last week, the story really was on the mutual fund side of things of the liquidation. So let's go ahead and take a look at the database and we can see where that brought us to. So we've talked about this before. To find this, if you go to research and then all stats, that'll take you to this market summary page. And you can see we're now at a percent long of 29%. So at this point, we only have 5,356 total securities in our database that are showing any sort of positive trending mode at this point.
Hey, Mitch, could you go to full screen, go to print friendly screen? I think it'll give you a little better view there, I think, for everyone.
Sure. Give me 1 second.
In case you never noticed this little thing says toggle print friendly view. We'll get rid of the menus. There you go. Thank you. I think that'll be a little easier to look at.
So, this looking at the database this week makes me think of some conversations I've had with a couple advisors lately. They're looking for ideas as far as what is working right now. And the bottom line is there really isn't much that's actually working across the investable universe right now. Most things are in a non-trending mode at this point, and you're really seeing it within our database, where of the 12 sectors, only 3 are long at this point. 9 are neutral. Of the 102 groups, 23 are long at this point. So again, we're taking a very defensive posture right now on the overall database. I'm going to jump over to the stock side of things on the dashboard. So again, as I mentioned before, we had quite a bit of selling, and most of it did take place on the mutual fund side of things. But as you look, it was broad-based when it comes to the stock sectors. Basic materials had the largest selling of 8%, and most of the other sectors had somewhere between 3 and 5% across the board, exiting out of those existing sectors.
That might have had something to do with gold and all the commodities continue to get hammered with the strength in the dollar as well. And I was talking, just real quick, Mitch, I was talking about their database getting to that 29 to 22% level. That's typically where it will go. It's sort of a garden variety view of the world, but it really is of how most of the declines go. But once we get to that level, the fact that we're down at 29%, it takes a while for the markets, for all of these markets and all these trends that have been broken, it's going to take a while before they were going to be able to consolidate, set up patterns that will be bought back again. When you get into this type of pattern, even though you're looking at the market, a few percent from all-time highs, that's really, that's just the way it's going to work here. But what it does is sets a tone for an elongated event from that standpoint.
Yeah, you had mentioned commodities, and that was one of the things I wanted to mention on today. I mean, last week we saw the selling take place, and you can see that when it comes to commodities, we don't own anything right now in the commodity space on an optimized trade system. Some portfolios may have still some positions using the 3.2 trade systems, but most commodities that I've taken a look at, especially gold and other precious metals that have been mapped to the 1.2 trade system, those are flat at this point. So what we're seeing across the board using the optimized trade systems is that we do not have positions in those commodity funds or ETFs at this point. Scrolling down the list, I mentioned before, last week we had a lot of selling in the allocation funds. We're seeing that continue this week as it gets carried over. So we went from being fairly aggressively invested in these allocation funds, which most advisors using VPM don't use, but that has brought the total. So that's really where a lot of that selling has taken place. But even if you go through this list here, you're seeing that there's quite a bit of exits across the board, also in international and in the domestic markets. One thing I wanted to mention, we had talked about this a little bit last week, was the idea of using these inverse positions. We still haven't seen much in the way of traction on the bear market fund side of things. So there is this idea that crops up every now and then that advisors have, that just because VPM sells out of things, a long position, then it must be a good time to go ahead and buy the inverse of it. And that's not necessarily the case. VPM sells a position because the trends have broken down. We're not showing any sort of positive movement. It doesn't automatically mean that the inverse is true, that we're showing traction to the downside at this point. But it will be interesting to see how this traction takes place in the bear market moving forward.
Yeah, and that's one of the points that I've always talked about, and that's what I was saying. The fact that we're at this 29% long at the moment doesn't have much relevance as far as the market declining. I actually love what happened today, because if you did have stock to sell, we had a higher opening sell into strength. And not only that, if you were panicking when was that, Thursday morning when the market was at 11,
right,
at 1926, that's the wrong time to do things. And one of the analysis that I did many years ago is the reason why we sell on Monday, literally about 66% of the time, whatever happens during the previous week, you will have that dead cat bounce, and you'll get a better price on Monday than you would have in responding and panicking in the sell-off that occurred, whether it's an individual stock or index or any of that. As a pretty good example is we had a lot of things get triggered on Friday, even though they're materially there's maybe 600 real trades that were optimized, that were in the target range if you use an optimized system. If you're outside of that box a little bit, which is fine if you've evaluated, but the point is that we're at a point now where we're taking protection for one reason, is that there's more risk than there is potential on the upside. And when you're a trend follower, that's what you're going to do from the standpoint of moving these assets around. And the realities are, I'd rather be selling at 1900 and something than buying at 1900 hoping for the Morgan Stanley 3000. Maybe that will hit 3000, but I don't think it's going to hit 3000 in this cycle. Maybe we drop to 1700 or maybe even 15 or 1600. Then maybe we can reset the markets. Maybe there's some fundamental change at that point that the market can do another ramp higher. There's some indications that I talked about on Friday's meeting that may not be the case, but anyway.
Well, and one other thing in line with that is, right now that the database is taking on a capital preservation mode. We're shifting slowly to that more defensive stance. That doesn't necessarily mean that we should be taking more risk on by grabbing any inverse position out there that's available. Right. So at this point, let VPM exit you out of those equity positions or those bond positions, if that's the case of your particular bonds, and we'll wait for those opportunities. And if there does appear to be some traction on the downside, we could talk later as far as what are some opportunities there. But again, those are really small things you want to be taking on at a time. Going further down the list, you'll see that when it comes to the international equity space, we're largely out of it. A lot of the events that have taken place overseas, both economically as well as the world events, have caused us to exit almost all of these positions at this point. So don't be surprised that you have a very domestic focused portfolio at this point, and it's probably going to be large cap based as well as bond based. As you can see up here at the top, we have a fairly large stake in the municipal bond space compared to the taxable bonds space. If you look at taxable bonds, we do have a fairly healthy exposure to it at this point, but not nearly as large as the municipal bond space. Of course, this was the opposite just a year ago. So we've seen a full rotation take place where we went from having no participation in municipal bonds to now being long almost all municipal bonds in our system. And then the taxable bond funds as well as the U.S. equity funds have seen a fair amount of selling across the board. This week, we also did see a fair amount of selling in the large cap space. We finally did start to trim off some of the large growth positions as well as some of the blend positions. And we did see continual liquidation of the value side as well. So we are seeing finally that movement out of those few funds that actually have been performing well this year relative to all the various other markets or indices that are out there. Jumping over to the weekly research, this is sort of a fun bit of perspective to see what is actually taking place in various different types of asset classes as well as across the globe with things like the iShares global positions. And you'll see, again, we mentioned this last week, if it has this gray square off to the right, that means it's flat. If it's a light green, it means we're long. And if it's a dark red, we're selling out of it. And that's all you're going to see is lots of gray boxes. A few positions are currently long. We're taking quite a few exits quite a few positions off the table with the latest bit of exits. And again, we're still holding strong in the position in SPY at this point with a whopping 0.59% gain. So even that is starting to be into fade. And we're going to be looking at that to see at what point we finally do issue that sell signal on SPY. Lastly, the globe at a glance. This week we had some more selling, some more losses take place as more countries across the globe began to take on shades of red as opposed to the green that they've had previously. So we're seeing this convergence across the globe of the markets turning negative year to date. So this does not bode well for things to come for the last bit of fourth quarter.
Yeah, Mitch, and you look at this chart, you can see Europe, Russia, Australia, all these commodity-related countries, as well as what you can see where the sanctions are causing. And look at Canada and America, bright green, and that's been the story. And everybody is leveraging off of the U.S. growth story, even though it's a little bit, I guess, what is that? Turkey and India has some positive. Well, how much positive is that?
Turkey is just barely at 1%. India, of course, is up nicely at 22%, right. But they're pretty much isolated out there as far as being the only markets at this point that have sizable gains. Most are not positive that much, especially if you start looking at other indices within those markets, like the Russell down 5% or 6% on the year.
I guess we look at Russia and China in there, right?
Yeah, China down 2%, Russia down 21%. Yeah. So Russia's market certainly has been hit, and it still doesn't appear that Putin really cares about any sort of sanctions because, as we've talked about before, it's going to hurt Europe a whole lot more than Russia at this point.
Yeah, and they're just becoming better friends with the Chinese. They're more aligned in ideology anyway, in a lot of ways. So that's what's going on there. So Europe's try and to try to punish Russia for getting back the only warm water port they have in Crimea. It didn't take a rocket scientist to figure out that if they would get that back. And we'll see how the whole Ukraine and what happens there. Ukraine is one of the most mismanaged governments on the planet. They've been borrowing money just to keep alive, so they're not economic output anyway. We won't get into that story, but this when I look at this really tells you what's going on. You got Mexico, South America, you got most of the countries of the world are negative while we're positive. At some stage, if these guys are negative, China's slowing down, all of these things are happening, at what phase do we get once we do all of our organic growth and we get a reasonable amount of people back to work making something, spending something, where does that party end? And it would appear to me that we're probably closer to that end than not. So,
yeah, the thing that concerns me is, we're very much a world market at this point. We saw 2007, 2008 correlation go down to 1, and it appears that that's quickly becoming the case again this year.
Yeah, and it's like we talked about the small caps leading the way down and doing all that. Well, there's other bigger picture items out there that are driving these markets as well. Good news is we are positioned to stave off any of the real effects of these things right now because of the position that this is pretty much what you see. We're long large cap SPY and those type of stocks. If you went through the stocks and broke everything down, that's what we own, and those are the only things that are working. You go to small cap and you go to mid cap. Mid cap's more neutral than it is negative, and then you see a little bit of bias on the NASDAQ and some of the tech stocks. There are some things there that work, but even that is a very mixed picture. And the key is, large cap growth primarily, and even the values work to a point. But when you start to look at value screens and other types of screening methodologies, your stock list is getting smaller and smaller up here from the standpoint of what you're going to screen and find in just about any criteria. So in any of you that are doing individual stock portfolios, you know this to be true, especially if you're in a value window. It's real hard to get a lot of stocks right now. And I always said these screens that we do and anybody does, when you start screening for growth or value or like the original, one of the old strategies I put out in 2008 was a GARP doing a growth at reasonable price. It's really difficult to find those type of items out on the list right now. They're almost non-existent. There's some, and then when you look at them, you're like, no, even VPM's already owned them for a while. It's really tough to find a rotation in some of these style boxes when you're screening right now. And if that's the case, if you stick to the criteria, this isn't a process warrior show, but if you stick to that criteria that you have in your breakdown from how you're supposed to update and walk forward your process, it just is going to all come out to the end of having a lot of cash, because you should be putting new symbols in your database into your strategy that doesn't have a position to map out your outliers. The ones that you do own, you let them run. The ones that you don't own, you're trying to do the outliers. And if you're doing the outliers, then you're not adding to anything here. You may be changing some of the stock list, hoping that this stuff goes. I remember in 2008 when Goldman Sachs was on the value list coming into July of 2008. Even though it was on the screen and even though you would have put it into your portfolio meeting that criteria, we never owned it. And we didn't own it until later in the cycle. So the screening, the fundamental screen with the overlay with VPM, with the quantitative and technical aspects, are going to help you. Even though you're doing screens, it should keep you out of the way for the most part. Sorry to get off on a tangent there, but it's sometimes these things trigger. But this is exactly the way the world looks. This is exactly how VPM looks on everything. So when we look at these graphs and you start to map out what's going on in this planet, it's clear just by taking a minute. I still don't think enough of you look at these charts because they're very significant, and especially if you're sitting and you're doing third quarter reviews or however you have your review cycle. These are absolute things that should be discussed while you're talking to your clients, and so they understand what's going on in the world. They don't just look at the S&P and why aren't we up 8%? That's not the point. The point is that even you have a global strategy, you have an allocation strategy, you're 60-40 or whatever you are, it's a whole different world and that's why, and you guys know this, when you start to benchmark against the S&P, or a client comes in and tries to hold you to that benchmark and you look at what they're doing, it's a mismatch to start. All we're trying to do, all of us included, to you and to the customers, is get their money to grow and not expose them to an excessive amount of risk. And in the end, that's what they want, but they also in 2014 want that instant gratification, like, I want what I want now. I should be getting more of this. I should be getting my share. And that whole inequality theme that's out there in the world, that somehow all the those of you that have small kids out there, everybody, the participation trophy syndrome. Everybody should get a part and it should be fair. I saw a Navy commercial watching football this weekend, and sure enough, their slogan now is to be fair to all. That's their very last thing, to protect the Constitution, to do this, but to be fair to all. So participation trophies and fairness is the theme on the planet right now, and in reality it's just an illusion that a lot of that can ever be achieved, but it's a political point. Sorry to get on that rant, but it really is what. So when you start to look at the markets of the world, you actually see where stimulus works and where the Fed's done here and where it's not working, and that most of the world is broken. So does that take us down? Can we save the world again by growing our economy? And our economy's, they're showing some crazy numbers, 4.3%. I think all that will get scaled back and will probably be 2.6 or maybe 3% year in. And those will be revised, don't forget, all the way into February and March of next year. So all these numbers are moving targets, and it's really about the perception of the risk that we have, and that's why VPM is like it is right now. The perception of risk is very, very high right now. Whether that shows up or not, we'll see, but it sure looks like on all the things we're talking about on the technicals, everything that we're seeing out of the database. I've been running this database in one form or another since 1996, 97. 96 when I built the first VPM prototype in 1996. So I have a long, long history. The database wasn't nearly like it is. It used to be about 3,000, and it grew to 6,000, and to 10,000. Now it's 18,000 symbols. And I've talked about this before, but the realities are when you can monitor 18,000 plus symbols, and this is what all of this transparency we're showing you is a real picture of what's happening, and everything unfolds in a different mode. So when you start to look at this thing in depth, then you can start to understand what the attributes are and what it's going to do for your money. That was a pretty big rant. I apologize, but I think it's important to understand that, and I really do. And I guess usually what I do, unless you got anything else, Mitch.
Well, just one little side comment. Just thinking about the jobs numbers last week and the surge in employment for those 55 and older, the comment that I often make to advisors when they come on board is one of our jobs is to make sure that our clients who trust us with their nest egg don't become Walmart greeters at some point and have to re-enter the workforce unless they really want to. That apparently hasn't been the case for a large number of people in that age group, because we're seeing a large amount of employment in those ages.
But you have to realize that one thing is that for the most part, our segment, our industry deals with not all of them, but a lot of, not the 1%ers, but the upper 5%.
Oh, I know that.
So we all have, all of us here, everybody watching this and anybody in this business has a different perspective than a lot of folks, and maybe we could even call being out of touch a little bit. I have been in this business for 35, working on 36 years, and I can tell you, never once in my career, no recession, nothing's ever affected me. I've been in production, and all the people I dealt with are people that have money, myself or clients that I had when I was on the client side of the business. So I've never actually never been laid off because of this stuff. It's been a wonderful path I chose, because I was originally in the real estate business. When I came to the brokerage business, it was the best thing I ever did. And so what it did, though, is, yes, there were some lean years, but there were never years that I didn't have a job. I wasn't able to do things. So there's always ups and downs in any industry. But the bottom line is, this is a pretty special place we all hang out. And I love this stuff. I have to tell you, I love it. I live it to this day. After 36 years, I have the same type of enthusiasm that I've always had, and I love what we do. So anyway, let's take
last minute. We got we're hitting new lows in the session, or just testing new lows.
Yeah, I was going to bring that up so we can bring the futures up here real quick. I'll go on screen here and do my normal closing here with a minute to go. And what we're seeing here is Futures are about 5 ticks off the low, so we're down 873. Maybe this thing can accelerate. We're at 59. We just went through S1. All right, so let's see where we are here on something here. I want to make sure we have the right graph up here. But we just went through S1 here. And when you look at the futures, there's two things I want to show you. So I'm going to run over a minute. Here's the futures declining. Like I said, this was hoping to be a low. We made it. Anytime there's a cycle coming in and it penetrates the previous low of that cycle, it negates that cycle and rolls it to the next period. So now it's possible to decline into the close of the day now, the way that it's broken down. So we're definitely have big time pressure on the downside, and that's where that goes. And one of the charts I did not bring up is this international spread chart that I usually have up, and I'm going to spend 30 seconds and then we'll be off air. These patterns are starting to show an interesting pattern. We have not seen this type of pattern before. They're like little mini, if you will, head and shoulders bottoms, but we're still in a downtrend here. But like I've said, I don't know how many times, our markets will start to decline when these spreads turn up, because what's going to happen is there's going to be a massive amount of outflow of money out of the U.S. As we can see, the green versus the red on the international chart, all this stuff is going to start to flow the other way eventually. And whether Europe goes up a lot, we will be going down faster than they're going up, or we'll be going down faster than they're going down, because they're already down. So most of the risk in Europe will be played out at some phase because they're ahead of us. So Russia's down 16%. And I mentioned the other day that I did see some people for the first time a couple of weeks ago starting to talk about flipping this spread. And this will be the international play. You'll see all this happen. This will be the top of the Dow. This will be all the elements we talked about on this show. Anyway, folks, I'm late, 2 minutes over. Appreciate your time and your patience and your business and your faith in what we do, because we work really hard to make us all the best we can be. So have a great day. We shall talk to you on Friday.